Good morning, Maijo.
Good morning, how are you?
Yes, I'm okay. How is everything?
We are fine.
Wonderful, 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 wonderful. How is the market?
It's just the same.
It's just the same. Okay. Why is it the same?
Because I'm not getting money from the market.
Why are you not getting money from the market?
I'm failing to master it.
Why are you failing to master?
I don't know.
Okay. Mr. Didix, how are you? Mr. Didix, good morning.
Yes, I'm okay, sir, and you?
I'm very well, How is the market?
Yes, I've been waiting for the reversing for me to get in. So it has been delaying, but I think it's just this morning now, it's showing now a sign.
What, VIX 75?
Yes, VIX 75. I just get an opportunity for C3. So it's the one that I'm in right now.
Okay.
It's on the selling, I'm selling it, yeah.
C3 are selling?
Yes.
Okay. Wonderful. It's a beautiful selling. It was a beautiful selling opportunity. Here it failed to break like this level here. If it broke this level, we're going to be safe with buys maybe too, but it failed to do that. So sales, yeah, it has been selling for the past 3 days now.
C3, I just enter on 36.20% something.
On which time frame?
15 minutes.
Okay. Yeah, that one it's possibly selling. Just looking from the daily point of view, this trend line is restricting the market to still play lower here. So it can still drop maybe to this level. So this thing, what it is doing, it's what's called an asymmetrical triangle. An asymmetrical triangle is a triangle in which the market will be forming lower highs and higher lows. Such a triangle, let me just hide this. So this is a triangle.
Yes.
Right. So this sell entry, you could have gotten a beautiful sell entry from this level here. First, it touched second, touched third, touched there, the top there. That trend line could have guided you to take this sell. So the asymmetrical triangle now, lower highs, as you can see, these are lower highs, lower high, but we are having higher lows, higher lows. Most probably a higher low again here on that touch here before it goes back. So asymmetrical triangles, they always break either side, either to the upside or the downside.
I'm just waiting for it to break the shadow which I took like a neck, the neck. Then from there I'll just gonna put my move my stop loss there. I want just to break that shadow. Is my neck line. Then I'll move my stop loss there. Then I'll start gonna watch his movement.
Okay,
if it's gonna come up again or it's gonna continue down, then I'll see.
Okay.
Yes.
So one thing that I have to say to you guys, like the majority of people who are always not really moving well consistently, you know, analyzing on the phone, there's a lot of defaults, there's a lot of disadvantages when you're analyzing using a phone. It's limited to a lot of things, so many things. That is why, as you're making money, try to invest, buy a laptop or buy a desktop. That way it's much more better to analyze. You can actually see things accurately more than on a phone.
Yeah, true.
Do you understand? Yeah. So
yes.
The reason some of you might be saying, I'm not really moving forward, or I'm making money today, losing money tomorrow. Some of the reasons, it's not even about the strategy. Most of the times, it's about the gadgets that you are using to do your analysis on. You can't analyze on the phone and expect to see a clear analysis on the markets. There's nothing like that. The phone is always limited to a lot of things, very limited to a lot of things. If you can buy a laptop, try to get at least a tablet which has a bigger screen, because that way it's much better to see to look at the market. Right now I'm on the laptop because just on the laptop I can actually show you that this sale was actually supposed to be sold here. For the past 3 days, this thing has been selling. I can actually see that. Then here I can actually see that this is a higher low. I can actually see that this market is forming lower highs and higher lows. Already I have a projection already according to what I'm seeing, that this thing can actually come here, give a third touch, go up again, maybe before going down or going up. These things I can only see them on the laptop. I can see that, but on the phone you realize that when you try to zoom in or zoom out, you're not even seeing things clearly as you can see right now on the laptop like this. So try to invest in your this is your business. When you are having a business like this, when you are making money, try to reinvest it back into your business, because the good part of reinvesting money back into your business, it's always going to give you better returns next time. If last month your equity was $100, then you made a profit of, let's say, $200 or whatever. If ever you reinvest, let's say 50% or whatever percentage, it means the next month you are creating a higher probability of you making a higher amount than last month. That is why we always say the returns of trading, they are exponential. They are never fixed. They have a room to improve in each and every day, each and every month. There is high room for improvement if you know what you're doing and you are keeping consistent and doing what you're doing. So try to invest in your laptop. Try buy a laptop, buy a desktop, or buy a portable tablet to make sure that you analyze there first before going to place trades. Either placing trades, you can even place trades using your phone. But a phone as well, when you're placing trades, it's also has a disadvantage because it doesn't show you how much is your stop loss, how much is your take profit. It doesn't show you all of that. But the laptop or desktop, it shows you everything. How much is my stop loss? How much is my TP? Most of you, the reason why you put stop losses that are not reasonable is because of the fact that you're using phones to place your trades, and you don't even have a calculation in mind to say how much is my stop loss. You don't even know that. You're just placing trades randomly. Do you understand?
Yes, sir.
So you
Yes, sir.
realize that most of you who are saying we are maybe still facing challenges. Most of you, it's just simple things, simple things that you're not doing. Simple things like getting a laptop, getting a desktop, getting a tablet. Simple things like that can actually hinder you, because if you don't know how much is your stop loss, so what are you doing? What lot size are you going to use? Are you calculating your lot size based on feelings and emotions, or it's a logical calculated stop loss?
But I'm always use a laptop, because even right now I'm using laptop.
Wonderful.
Every time, whenever I want to analyze market, always do it on the laptop, because
Wonderful.
It doesn't give me a nice view to see.
Very true.
Yes.
Very true. The phone is always limited.
Yes.
So first 300, the sell is very valid, still valid. I showed you the target there at the bottom. We were expecting a higher low again to form before going up, because in asymmetrical triangle, let me just give you this example. Right, let me just give you this example. I hope this one it will make things much more clearer for everyone. The market moves in the following ways. The market moves in the following ways, right? Take note of that. The market moves in the next following ways that I'm going to show you now. Right. The market moves in these ways. We have an uptrending market. We have a consolidation market. We have a downtrending market. We also have an asymmetrical market. This is an asymmetrical market. Right. How do you identify these four types of markets? An uptrend you see by the formation of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. This is an uptrend. So whenever we see a scenario like this on the market, we know the market is uptrending. And when the market is uptrending, one fact that we know is that all the higher highs are always going to be broken. Take note the higher highs, not the higher lows. The higher high, when we're uptrending, it's the higher highs that are broken. Higher high, higher high, higher high. So what does the market do whenever it wants to turn from an uptrend to a downtrend? It fails to either go and break this higher high. Those are scenarios whereby you see the market forming either a double top, right, before going down. This must happen before it goes down. Either this double top, triple top, head and shoulder. Those are all scenarios, same scenarios, but they're simply showing you the same thing, that the market, for it to turn from an uptrend to a downtrend, it has to shift the market structure. Higher high here, failed to make a higher high. Remember what I said about an uptrend, the higher highs must be broken. Here, this higher high was not broken, meaning first sign, second sign, higher low was broken, which is now contradicting to the principles and the laws of an uptrend. Laws of an uptrend, we say the higher highs are broken, not the higher lows, not the higher lows. When you see the higher high not being broken and the higher low being broken, that is now a violation of uptrend market rules. Meaning, someone who is going to take a sell after such a confirmation like that, the probability of their trade being in profit is higher than someone who's going to try to take a sell in an uptrending market like this. Because in an uptrending market, as I said, the higher highs are broken, not the higher lows. So we also have what you call a range. A range is whereby you are forming same highs, same lows, same highs, same lows, same highs, same lows, same highs, same lows, up until we break either to the upside or downside. That is what we call a range or a consolidation. Ranges or consolidations, we are forming same highs, most probably equal highs and equal lows, equal highs and equal lows. That is what we call a range. Best entry to take in a range is after the breakout. Breakout of the range is best entry point whenever you want to have the best confirmed entries. Because once it breaks out, it means it has confirmed that either the sellers or the buyers have won that battle, because this is a battle between sellers and buyers. Both of them, the buyers, they are failing to break this zone, the sellers, they are failing to break this zone. So whichever side breaks their own zone is the side that is going to continue. If the buyers win, they're going to break to the upside. Once they break to the upside, we know that the buyers are most probably going to continue to push price higher. That is why taking trades after the breakout of the range is the best entry point that you can ever take. Third scenario is a downtrending market, forming lower lows, lower highs, lower highs and lower lows, lower highs and lower lows. Take note of the difference between an uptrend and a downtrend. A downtrend, it is the lower lows that are broken. It is the lower lows that are broken, not the lower highs. It is the lower lows, lower low, lower high, lower low. It is the lower lows that are broken. When you see the lower high being broken, it means the market has violated the rules of a downtrend. Most probably we are entering a range or we are entering an uptrend. So once you have in mind that I'm now in an uptrend, those are moments that you know that I need to focus and look for more buying opportunities than selling opportunities. In a downtrend, we look for more selling opportunities than buying opportunities. Then this last scenario, which we called an asymmetrical, we are forming lower highs, but higher lows. This is not an uptrending market. This is not a downtrending market. Remember what he said, what is an uptrend? Uptrend, we have to form higher lows and higher highs. These are not higher highs. So it's not an uptrend. Is it a downtrend? Let's see. Lower highs, it has to form lower lows. These are not lower lows. It's not a downtrend. It's not a downtrend. It's not an uptrend. It's not a consolidation. It's an asymmetrical. This is the fourth market scenario that you can always find on the chart. So these four scenarios that I've just mentioned, these are scenarios that you always have to look out for on the market. Before you even take trades, look and identify the current market that the market is moving in. Are we in an uptrend? Are we in a consolidation? Are we in a downtrend? Or are we in an asymmetrical pattern? Once you identify that, you are good to go. Most of the times, whenever you identify the market condition that you're in, it's very rare to take a losing trade. Very rare to take a losing trade when you know the market condition that you're in and you know your entry points very well. Once you know that, you have a higher probability of winning your trades more than someone who's just coming to the market, placing trades without an understanding of these 4 different market conditions that the market flows in. So at every given point in time, the market is either flowing in uptrend, consolidation, downtrend, or in an asymmetrical pattern like this. An asymmetrical pattern is simply uptrend. When we're uptrending, it means who is in control? The buyers are in control because they are pushing price higher. Check note, price is being pushed higher there. Price is being pushed higher when we're uptrending. Can you see that?
Yes, sir.
Buyers in control when we're uptrending because price is being pushed higher. Price started here, but right now it's there. It's not going lower. Price is not going lower, but it's actually going higher and higher and higher and higher and higher. Price started here, moved higher, 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 higher. So when you are downtrending, the opposite is in control. The sellers are in control. That is why I always tell you, when we're in a downtrending market, focus on selling opportunities more because the sellers are the ones that are in control. The price is going to be pushed lower and lower and lower and lower and lower, meaning someone who's going to focus more on selling is going to make more money than a person who's going to try to buy because the buying opportunities, they are very few. The buyers are not in control here. It is the sellers that are in control. In a consolidation, no one is in control there. Both parties are participating, are in control. So it's a fight, it's a battle there. A consolidation is simply a battle between buyers and sellers. That is why I say, wait for the breakout. If it breaks out to the upside, it means the buyers have won. If it break out to the downside, it means the sellers have won and they are going to continue pushing price lower. Here now, asymmetrical. No party there is in control. Both the buyers and sellers are trying to, it's what we call, someone can call it indecision, or it's also a form of a battle whereby both the sellers are trying to push price lower, the buyers are trying to push price higher. These are the buyers, this bottom line, the buyers, this downward line, the sellers. Sellers are trying to push price lower, buyers are trying to push price higher, up until either side, either the buyers or the sellers win. If the sellers win, that's why you see the break happening to the downside, meaning we take sell positions. Why are we taking sales there? The sellers have won. When sellers have won, it means price is going to be pushed lower than where it is. If price is going to be pushed lower than where it is, it means we have to sell in order to make money.
Yeah.
Do you understand?
Yes, sir.
These are the 4 market conditions that the market is always going to move in. You're never going to have any other scenario. Either we are uptrending, downtrending, consolidating, or asymmetric. We are in an asymmetrical market condition. Once you have such an understanding, let me tell you the truth. Once you have such an understanding like that, you have a competitive advantage over the majority of the traders that are just coming to the chart without such an understanding. You have an advantage over so many traders that are just coming blindly to the market. For example, Crash 300. Currently, we are in an asymmetrical market condition. Currently. Why? Why am I saying that? We are in an asymmetrical market condition. I saw these lower highs. Okay. I saw lower highs. So when we see lower highs, which scenarios in the market give us lower highs? It's either it has to be a downtrend or an asymmetrical. So for it to be a downtrend, we had to form lower lows. So if you trace these lower highs, we had to form lower lows. If you check here, it failed to make a lower low. Check here, it failed to make a lower low, meaning already it's not a downtrend. This is what you are doing before even taking a trade. This is what you're actually doing an investigation, market investigation before even taking a trade. You are taking data, you're taking information before even making a decision. You're taking information from both the buyer's perspective and the seller's perspective. Before you as a judge, you make a decision to say, right now the buyers are in control, right now the sellers are in control, or right now no party is in control. This is a serious investigation that you need to do each and every time that you come to the market. The first thing that you have to do is investigation. Always know that before even don't be in a rush to take trades without investigation. You lose money for nothing. You lose unnecessary money for nothing. You lose, and just wait, do investigation first. After doing an investigation, after you've done your investigations and you've identified your entry points, according to this investigation, we realize that we are in an asymmetrical pattern. In asymmetrical pattern, we can either wait for the break. If it's on a higher time frame like the daily like this, you can sell at the top, buy at the bottom up until we get the breakout. Either way, if ever it's going to break to the downside, it means the sellers have won. The sellers have won, meaning price is going to be pushed lower, meaning we can take sell positions. So after doing your investigation, according to the daily here, according to this investigation, this is a good entry point. Your exit point, you're expecting somewhere at the bottom of the pattern like this. This is your exit points for these sales that you took there. So investigation, and this is the most important thing that you need to do before taking a trade. Taking trades is the last thing that you do on the market. Do you hear what I'm saying?
Yes, sir.
Taking trades is the last thing that you do. If you check most of you, especially the ones who are not consistently profitable as yet, the first thing that you do whenever you come to the chart is to take trades. Yet it's the last thing that must be done according to the law of profitability in the market. According to the laws of profitability on the market, taking trades, placing trades is the last thing that you do. I hope what I'm saying is clear.
Yes.
So first thing, you come, you clear your chart. Once you clear your chart of every drawing, unnecessary drawings, you come to the chart, you clear your chart. You clear your chart. Once you've cleared your chart, you identify the market condition that we are in. Are we in an uptrending market? Are we in a downtrending? Are we in a consolidation, a range? Or we're in an asymmetrical pattern? Once you've identified the condition that you're in, you now place your trend lines, you now place your support and resistance, you now do all of those sort of things. Once you do that, we go to a lower time frame, like the 4 hour, 1 hour. There you're just simply going to identify an entry point. That's your job there. You're not going to analyze, you're not going there to analyze basically. You're simply going there to identify an entry point based on the projection that you've done on a daily perspective, weekly perspective. So now, according to the 4 hour, you realize that we say this is an asymmetrical pattern. Our entry point is there, our exit point is there at the bottom, right? Yes. But then you realize that on the 4 hour, as the market is performing that asymmetrical pattern on the daily, it's moving in sort of like a downtrending way, lower highs, lower lows. Because if it's going to go down from there to there, it has to go down in a trending way, which is a downtrending way. That is where the confluence comes in now. You're confluencing what you have seen on the daily. On the daily, I saw that the market is forming lower highs and higher lows. But on the 4-hour, I'm realizing that as it is coming down from the top of the asymmetrical pattern, going to the bottom, it's not just moving, but it's actually moving in a trending way, meaning I have a trend already. That is being followed as the market is going down. That is the confluence of timeframes. You're confluencing different timeframes according to what you're seeing on those different timeframes. So the timeframes, they're actually blending with each other. This 4-hour is saying, yes, we might be in an asymmetrical. We are now going down to the bottom of the asymmetrical. But as we are going down, we are going in a trending way, which is why we have this downtrending channel. So that downtrending channel, it actually can guide this market as it will be going down. Actually can guide this market, guide this market, guide this market up until we reach our target here. It can also guide this market as it might start going up. It will also guide one for some entries as well. Do you understand what I'm saying?
Yes, sir.
So this is now the blending in of timeframes. When you see your timeframes blending in and you take trades based on those on the blending of timeframes, rarely are you going to experience losing trades. You might have, yes, small losing trades, that's understandable. But I'm referring to the majority of the times, you're always going to realize profitability. Because once you understand the blending in of timeframes, you now understand the rhythm of the market. The market moves in a certain rhythm. It does not just move, the market moves in a rhythmic way. That is why we have patterns. Patterns are formed out of the rhythmic nature of the market. The market is always rhythmic. What makes the market to be rhythmic is because it's governed by human beings. Human beings are rhythmic beings. Rhythmic in the sense that a human being can start and adopt a certain way of doing things, and they can actually continue doing that thing continuously, up until they break that cycle. If they don't break that cycle, they are still going to continue. That is why we always say breakouts. That is why I always recommend you to take trades after breakouts, because a breakout is simply the break of a cycle, the break of a certain cycle. Either it was a range, a consolidation, whatever. So when you take trades based on a breakout, you are taking trades based on the break of a certain cycle that was being followed. The market is a rhythmic environment. It's a rhythmic environment. Once you understand the flow, the minute you start to understand the flow of the market, the rhythmic way in which the market moves, let me tell you, it will be so hard for you to lose. It would be so hard to lose once you understand the rhythmic nature of the market. All this, what I'm showing you, are simply examples of the rhythmic nature of the market. When we are uptrending, it's a rhythm that is being followed, an uptrending rhythm. Up until it's broken, we will still continue with that rhythm.
Mm.
I'm just showing you what I'm saying. It applies to any market. Even if you go to trade NASDAQ, US30, gold, whether your currencies, whatever market that you want to trade, they flow in a rhythmic way. There are other markets that are always bullish. There are such markets like that. Markets that are whose rhythm is just a bullish rhythm. They don't change. There are markets like that. There are markets who are always bearish. There are markets who are always fluctuating, ranging. There are markets like that. Then there are markets that are diverse and they can be anything. They can uptrend, they can downtrend, they can consolidate, they can do asymmetrical. So once you understand the rhythm, ladies and gentlemen, once you understand the rhythm, right now, the reason why you keep experiencing unnecessary losses sometimes is because you haven't gotten the rhythm as yet. Once you understand the rhythm, let me tell you the truth about all these successful people that you see every day. They understand that life is a rhythm, is a rhythmic environment. Things, they flow by rhythm. Things, they flow by rhythm. Once you understand the rhythm, you are done, because you just move yourself in line with that rhythm. Once you move yourself in line with the rhythm of success, there's a rhythm of success, there's a rhythm of failure. For example, when you're talking about the rhythm of failure, we are simply talking about the cycle that makes people to continue failing. For example, when it comes to trading, what is that rhythm of failure? Not being disciplined, oversizing, overload sizing, taking trades first, which is the last thing that you must do. Not analyzing from a high time frame perspective. All those things, this is the rhythm of failure when it comes to trading. There's also a rhythm of success when it comes to trading. Once you get hold of that rhythm, you're gone.
Wow.
What I'm telling you, search anywhere that you want. Search on Google, you won't find this. The rhythmic nature of the market. Go and search on Google, you won't find this. You will never find this. The rhythmic nature of the market. The rhythmic nature of the market. Once you understand that, you are gone. These things are predictable. That is why you see the learned ones can actually predict the weather of tomorrow. It's not that they are prophets. They're not even prophets, the majority of them. They understand the rhythm nature of life, the rhythm nature of weather. They know all of that. They are not even prophets. Don't even think that they are prophets. They are not prophets. They simply look and analyze and study the rhythmic nature of weather. Then they use that rhythmic nature to predict things.
That's wonderful.